Welcome into the live stream today. We're going to be diving into the FOMC meeting with Chair Powell and his comments after, as you guys know, it goes into the press corps, and we get a chance to kind of hear a little bit more of that. So it's going to be a good one. My name is Paul Barron. Welcome back into Tech Path. And we'll get started today. I want to just remind you guys, our sponsor, LuxAlgo, one of the, I think, best trading tools we've tried so far, and I feel like we've tried them all. So you guys can enhance your trading experience just by going over, getting a 30-day risk trial right there, and it's pretty easy. They got some great solutions for getting into trading if you're into the charts. What I do is we blend both these charts along with our MSI data, which is our market sentiment index, to kind of get some variances on understanding where the markets are going. And so far, we've been and seen a tremendous amount of accuracy. So check it out, luxalgo.com. All right, let's get into a couple of points. I'll just go straight to the meat. And that is the FOMC has held, meaning no rate change. So they're holding steady. There's a thin median for 3 cuts right now for 2024. I still believe it's probably going to end up in 1 or 2 cut camp. Now, this being March, the likelihood is, do we see a cut coming after summer or pre-summer? I think that's the real question, is June. Core PC inflation forecast was revised up from 2.6 from 2.4 in December. And then the GDP forecast for 2024 was also revised up from 2.1 from a 1.4, which is pretty significant from December, just a short 4 months ago. So there's a handful of things that are happening from a global and economic situation right now. Obviously, the sticky inflation is one of those things that plays into this whole narrative for the Fed. And remember, if you're new to finance or you're new to our channel, first thing I ask you guys to do is smash the like button right now. Take some time on this live stream, hit the like button. We're going to try to get to some of those. And if you want us to do some charts today, let's hit the like. Let's see if we can get to at least 500 likes. Maybe we can. We'll try to do a poll also for you guys as well. So make sure and hit the poll as well, and we'll get into that. We are going to be airing the live stream over on the Fed meeting. Let's cut over to, can we cut to the Fed? I just want to kind of see what the time slot looks like. Yeah, so it's going to come up here. They should be starting to air here in a minute. And of course, Chair Powell always jumps in. He'll start going into his Q&A with the press corps. And one of the things that he does is he starts to look at, and he kind of reveals what the meeting minutes were about. And this is in reference to all the entities that are involved in setting the Fed fund rates. And a lot of times the way he answers tells us a lot on whether or not we are going to see a potential cut in the future, or if we might continue to see this kind of scenario where it's more of where it's going to, higher for longer kind of scenario. So we'll play into all of that. Here was Koibisi since Fed raising rates since March 2022. They've made it clear 2% is their target. I think this is a problem right now. Many people still believe that that 2% may be unattainable. And when you look at some of the things that happen around inflation over the past 5 years, it's a pretty significant increase. If you look upon compounded inflation, you're talking about 22 to 24%, depending on which number you look at. But when you look at the real inflation numbers, it's upwards of 40 to 60%, depending on what numbers you look at, on the amount and the value of your dollar going out and spending today in 2024. That is a significant difference. And I think that's the whole point around the idea of de-dollarization. It's also why I still think we're seeing so much interest in crypto, even though I think a lot of people who are not really vested in crypto or understanding what's happening in Bitcoin, Ethereum, and all these altcoins, they haven't completely understood just how much the theft has been on their U.S. dollar. And when the U.S. dollar is paying at a 5% dividend right now, pretty much any respectable bank or any respectable money market out there giving you 5%, you know something is up in the game, and that is definitely what's going on. So a lot of things happening. If you look at this chart right here on the inflation rate, let me kind of zoom out on that. I mean, look at this thing. It kind of bumped right there, almost 10%, even though that was highly underreported. Really, that was more in the 12 to 15% range on core inflation. And you look at where inflation is right now. It's just been kind of bumping around here between the end of 23 and where we are right now in 24. And with our consistent situations happening from an economic standpoint, this may be, I think, the place that we are, and that's probably in between the 3 and 4%. If that is something that the Fed will, and I just don't know that Chair Powell will ever agree to that, because when you look at that, that is truly a death march for the fiat system, because that would be at 3 to 4%. Look at that over 40 years, or excuse me, 10 years. Now you're talking about 40% compounded interest inflation, and that's if you can retain it, because remember, a lot of these markets flex in and out. So definitely a lot moving on that. We're going to be taking some questions after Chair Powell today. We'll try to get to some charts. If you have a chart you're interested in, we'll try to get to them. If it's in our MSI, for sure. But right now, this was, of course, the breakdown. Why is Bitcoin dumping? Grayscale redemption right now. Past 2 days, Bitcoin ETFs have seen net outflows over 500 million. Also, Grayscale, don't forget, had a new outflow of 1.1 billion in the last 2 days, which explains a lot of the selling that we've seen. With really, these ETFs are guiding the course of Bitcoin much more than I think a lot of people, one, anticipated, and two, want to happen, because this does start to kind of look as a lot more centralization for Bitcoin. FOMC meeting decision, as we've said, he's going to be speaking here in a few. Bank of Japan was another issue that raised their interest rate for the first time in 17 years, which is leading to the sell-off. We're seeing a lot of that as well happening. If Powell sounds dovish in the meeting, the market can kind of resume its upward momentum. However, I'm in agreement if he does come in much more neutral or hawkish. If he's concerned about, and these are the things I think he'll be talking about, I believe that he's going to still be concerned about this stickiness on inflation. And I think he's worried about the upcoming election and the pressure it's going to potentially put on the economy if we continue to see inflation coming down. What does that look like? Do we get that bounce, which is what he's in fear of? Do we see us go down and then all of a sudden we're back to that cycle of rising inflation again? And I think that's the thing that is a big one. And the other thing is when you look at what's happening in Europe, there's quite a bit of scenarios that are considering, because remember, Europe has been in recession, and the U.S. is trying to kind of navigate this soft landing. Whether they're successful, I say we are successful, is still questioning, I think, a lot of the future of where all this is eventually going to go. And right now, it's a tough one. And you think about this, we're in a bull market. Yes, we have had some pullback on this. These are normal, but for the most part, almost every token, if you're invested in altcoins, even meme tokens to a certain extent, we haven't seen massive sell-offs. So we do understand that the pressure, and there's still liquidity in, the trillions that are sitting on the sidelines that are still uncommitted. And I think that's the other factor that is yet to be determined right now. Don't forget, we're still in bull market. BlackRock Fidelity still accumulating Bitcoin. Halving has not happened, and rate cuts will happen in 24. Question is how many? A lot of those are being under consideration right now. Another one right here. Overall data looks much more healthy than last week. Good amount of leverage wiped out. We saw that. Funding rates were normalized. Sentiment came down a little bit from the euphoria levels. It's interesting, too, because a lot of the sentiment trackers that you look at, whether it's on CoinMarketCap or some of the others that are the fear and greed index, they have not necessarily been keeping pace with what we've seen, which has been pretty much a declining sentiment overall. I'll get to some of those in a bit when we get to the end of the show. We'll show you some of the market sentiment data on Bitcoin and Ethereum, which has somewhat predicted what we're seeing right now. So I feel much more accurate in terms of where trader sentiment is going. This is another story that we just talked and put out a video with Mark Yusko on, and that is this issue with Ethereum. Now, Ethereum is in a very precarious situation right now where you've got an ETH ETF potentially at bay through BlackRock and many others issuers that are trying to do that. But here's Tara talking about if this is true, and this is talking about the SEC is waging a new legal campaign to classify ETH as the potentially a security, which would be completely different than what Gensler has talked about in his past, and we did a full video on this yesterday to explain why they would get an approval. And then the very next day, you get a lot of this FUD coming out. So two things could be happening. This could be just normal, transactions around crypto in general. Could also be Senator Warren's crypto army at work. And also, it could be a situation where the SEC is kind of in a position right now where they're awaiting a new administration. And when you look at a new administration coming down the pipe, listen, if Trump takes the White House, the likelihood is Gensler, if he follows the historical process of chairs in the past, is he would exit. Remember, his job goes out through 25, but in most cases, if the White House changes, in this particular case, going from Democrat to Republican, then at that time, the balance of the SEC, unless, Trump would say, hey, no, stay in there. But most of the time, those resignations come in. That's exactly what happened with the last chair on it. Now, a couple other things I wanted to get to, and we'll get into the FOMC hearing here in a second. This, of course, was talking about the attack by the SEC. Same as Binance, Coinbase attack. Markets bottomed. We've seen that. We saw the 3,200 ETH. And you got to remember that Fink and BlackRock just went in and dropped 100 million into ETH 24 hours ago. Now, the reason they did that was they're looking at launching their own tokenized security platform. So this being operated and essentially operated under the ETH blockchain. So when you look at those kind of moves from companies and investors like BlackRock, I think this is just a matter of time. And could there be some shenanigans working there in Wall Street? This is something that we've talked about often. I won't call it manipulation, but everybody knows how markets work, and supply and demand. Everybody's looking for those entry points, and sometimes those small dips in the market create those entry points. If there's not enough narrative behind what's happening in the market, in that, I always look back, step away from the trading screen for a moment, and realize when you look at all the narratives, if they're still positive, and you just see this one blip, much like what we saw with Ethereum. I'll go over to the chart and just show you right here. I'm on the 15. Let me go to the daily real quick right there. Yeah, so here's the daily. This essentially is this fall off right here where we saw ETH running at the 14th of March, right around 4,000. We started to see a little bit, but this day was the big one right here. And that was going in from around 3,500, dropping down to around 3,150, but really seeing that wick, you're talking about right under $3,200 ETH. So a couple of things. If you guys are not familiar with these Lux Algo charts, one thing you'll notice is on this signals overlay is these little blue X's right there at the top. Those are selling signals, take profit signal. Typically we get this on a post data from the daily close. These are some good tracks. Also, I look at the money flow right here, which is the oscillator matrix, kind of giving you some ideas of where the money flow is coming. Money flow hasn't evacuated ETH as fast as you would think it would with this kind of news, so that could be pretty good. Going long term, not necessarily as of today. Remember, don't trade in these crazy days, even though ETH is back up 5% on the day. So we'll see. A lot happening right now. And of course, now I think with the fact that we've seen, let me go over to the 5-minute chart. Now that we've seen the decision come in, we'll click back in here in a second. There we go. We're on the 5-minute. Now that we've seen the decision come in, essentially right about right here at 1,700, you start to see a little bit of a climb out for Bitcoin coming back in right at 64.7, holding 64.3 right now. So definitely something to watch. A lot of questions coming in. We'll try to get there for sure for some of those. I don't know if we have the poll yet. We'll probably do one at the end as well. You guys want to try to do an update on the poll? Sound good? You want to try to do it? All right, let's take a look at it. Hang on just a second. I'll pull a poll up for you guys, give you an idea of what it might look like here. And hang on one second. We'll get there and open that up for you. Because sometimes we do these polls, and the way we do it is through, well, maybe we do it that way. Let me see if I can get to it. Yeah. Are we getting ready to go live here? Oh yeah, we are. While it's going live, I'll get that poll up and then we can show it here in a second. Looks like they're starting to air. Chair Powell. And I'd love to get you guys' comments on, one, when we do these live streams like this with Chair Powell, then a little bit of commentary after, I'm wondering if we should listen to, because typically there's a handful of reporters that ask really good questions. There's three that I look for. And if we can get to them first, we might be able to get a narrative of what Chair Powell does. Because a lot of times toward the end, it's just reporters kind of rephrasing questions that have already been asked. So we may be able to get to some questions here today and then also take a look at some charts on all that. So it will, and you know, with Chair Powell, he's kind of looks like he's coming in late today too. With Chair Powell, it looks like he's always got his favorites that are kind of interesting as well. So let me show that real quick. And don't forget to smash the like button right now. It's one of the things that does help us understand, first of all, if you like these kind of live stream, but it also does get the algorithm out there for the rest of people trying to find these kind of live streams. And hearing Chair Powell speak is important. So it's going to be a big one. I can show, there we go, I can show. Looks like he's coming on right now. Let's cut to him. Well, we're going to try to cut to him. There we go.
But inflation is still too high. Ongoing progress in bringing it is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Yeah, very dovish here right now, guys. We're getting some interesting data coming in.
Steve
from,
Leisman, CNBC.
FOMC.
Mr. Chairman, the projections
This could
show
mean something big.
somewhat higher core inflation.
Here's Steve
They also
Leisman. He's a good
show
one.
somewhat stronger growth. What should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to
key
slow the
question right
economy
there, Steve.
to achieve that target?
Just admit it, Chair Powell.
Well, it
Just
doesn't. No,
admit
it doesn't mean that. What it means is that we've seen incoming as I pointed out in my opening remarks. We did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down. And so,
When you just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
so we're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
Okay. And will you be able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Nick Timmeros of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, if we ease too much or too soon, we could see inflation come back, and if we ease too late, we could do unnecessary harm to employment
economy
and people's working lives. And so we do see the risks as two-sided. So it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
So I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, we wanted to be careful about that decision, and we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that you still need, or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
But, just a question of, is there even enough data for you to be able to?
We'll take.
Sorry.
All right, these are some very,
things
very
can happen
dovish
during an intermeeting
statements.
period. If you look back,
Very dovish statements. If we don't
things,
see
I don't
something,
I wouldn't
all right, so
want
you
to
just said
dismiss
we don't
anything.
expect
So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%.
They already have confidence.
I also
coming
mentioned
in on this. They know
we
something.
don't
They're
see
looking at
this
some data that
in the
we're not
data right
seeing.
now. But if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Chris.
Hi, Chris Regaber, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about what might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question? I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. My instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long-run rates that were at or below zero in some cases. I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already or you mentioned it being 2.8 in February. That doesn't sound like much disinflation at all. So are you still confident? Or the last press conference, you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, just are you still optimistic that you'll get the confidence you need this year?
I think if you look at the SEP, what it says is that it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, toward 2%.
Gina Smilik, The New York Times. Thank you for taking our questions. Per your comment to Anne that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah, so if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself, no. I mean, we saw,
That's interesting
you
that
saw
it said
last
that.
year, very strong hiring and inflation coming down
That's
quickly.
been one of the
we now
key data
have a better
points that has
sense
held
that
it back
a big part of that was
before.
supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Neil.
If you do
Hi, Chair
look
Powell,
at the
Neil Irwin with
Truflation
Axios.
Index,
How do you assess the
one
state
that
of
we
financial
follow,
conditions right now, and in particular,
continues
do
to
you
show
view the
consistent
kind of easing in financial
downtrend.
conditions since the fall as consistent and compatible with what you're trying to achieve
and
on
I'll
the
show you the
inflation
categories here in a minute.
So
This is one
we
you
think-
guys should track, though.
There are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite financial conditions sometimes being tighter, sometimes looser.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off
All right, guys, I think we have
increases?
heard enough from Chair Powell today. What you can take away from this is dovish statement after dovish statement. He has got either data that has not completely been revealed to the economy just yet, or they know something we don't, and that is that there was two things that I think we have to pay attention to. First was the potential for a double bump. And what I mean by that is a double reduction. Maybe there was one reporter that asked that, very specific, I think it was from the New York Times, right after Steve. And he did not come back and kind of defend against that. In fact, he said, hey, we think that's on the table. We're going to look at this. A lot of interesting statements there. And the other one that the young lady asked about the job situation, because this is one that has been a factor as well in retaining high inflation and the concern for the Fed not reducing rates. And that has been, if jobs are going up, rates aren't coming down. He said the opposite today. So again, more dovish for sure. If we look at the poll right now, how will crypto react after today's Fed meeting? We showed you guys, I don't know if we showed the early one. Right now, we're almost 3,000 votes in. 46% of you guys are saying we are going to see a pump. And if you go back over here to the charts right now, well, people, I can't even keep up with it. That arrow can't even keep up with it. Let's go ahead and get that arrow in there. Yeah, that's what we're seeing right now in the markets. And it's fun. You know, we got to have some fun with this. We're going to take a few questions. Thanks for the super chat there. Solana and Aptos, interesting, joining Google and Visa for the first decentralized application. That's cool. All very, very bullish. Yes, Robert, definitely. Is there enough data between now and May to go buy some more Solana? I think that's the question. And of course, you guys are having fun. Jay Powell said, buy more Solana. Yes, okay, you love it. Bitcoin halving, yes, that's going to have another factor into it. We could see a pretty good run here now with Bitcoin tracing over 65K. I think crypto Twitter has the message, and we're not going to be able to keep up with it for very much. Let's go take a look at Solana as well. And like I said, I am using our Lux Algo trading tools. It'll take a little bit to paint these out, but of course, we're seeing Solana as we started cracking 180 back again. So we're going into 183. There we've got some great trends coming up on the 5-minute right now. I'm on the 5-minute chart here on Lux Algo. So everything's looking highly up, or excuse me, on Solana on Lux Algo. The two indices I'm using right now is the signals and overlay. This is one I like that I use. So it's another one. And of course, the other one I watch right here is this. This is where you start to see that crossover for money flow, which is something we're starting to look at as well. If you look at the trends, though, this is something when you're looking at forecasting from our market sentiment index. This was forecasting where Bitcoin was going. So remember, this hit back here on the 14th on Bitcoin. We saw the dip. We haven't printed our sentiment as of this was yesterday's data. We haven't printed our sentiment now post FOMC, which we will do this afternoon. If we see some uptrend, I'm looking for uptrend right here, guys. This is a very significant sentiment data point in our market sentiment index. If this starts to climb back again into the 64 range, then I feel very confident we're going to continue to see a run on Bitcoin, maybe back to its all-time high that we've just recently reached. So a lot happening. A couple other things. Render bullish. Yes, the constant battle for what is a security is maddening with the ETH situation and the news on that, but also with the support of BlackRock. You got to remember that. Come on. BlackRock is jumping into the game, and it's going to get serious, I think, with the SEC going in there. Gary is definitely going to play into that for sure. What else do we have? As soon as Jerome says needs a side Bitcoin pump, yep. If you want to influence Powell, hit the like button. I agree with you. We need to hit the like button more often. We need to get this out there to the people who have not made their journey into crypto just yet. So make sure and smash it right now. It's one of the things that we do. And if you're not subscribed to the channel, make sure and do that now. And of course, if you're not in the Diamond Circle, this is where you got to come. The Diamond Circle is a great email list, but it's also a tool within Telegram where we drop additional content. Things from our MSI sometimes we'll drop in there. Matter of fact, I'll probably drop some in that Telegram group today. So if you're not in there, go get on the Diamond Circle and begin your journey into that. And if you guys can follow me out there on Twitter, it's @PaulBaron. I'll catch you next time right here on TechPath.